You're watching The Money Show. I'm Kavita Thapliyal, and it's a show where we do your personal finance planning. We help you strategize your investments. We help you select the right kind of investment instrument and also help you align that particular investment with your any financial goal that you have. This show focuses on your earned income, on your spends, on your investments, and everything about your financial life. So all you have to do is watch our show every day. And second, if at all you want to ask any question, you can do that. You can WhatsApp us your queries on our WhatsApp number that's flashing on the screen, and you can also email us your queries. Send us your existing investment details if you have any, or if you want to start your investment journey with the help of our experts, you can ask about that as well. Anything about insurance, whether you are adequately covered, you want more coverage, or just a first step towards securing your family from any financial crisis as far as insurance is concerned. We also cover insurance on the show. Tax, loan, any aspect of personal finance, we have your back. So, but let's begin the show today, and the focus will be on your portfolio queries. And I have with me our very special guest, Shweta Jain. Shweta, hi, good evening, and welcome to the Money Show. And Shweta, what happens is, although we just answer our viewer queries, but a lot of time through these strategies that our viewers send across, we get a lot of other investment tips or investment topics to talk about. So let's focus today on that. Let's just read between the lines and also focus slightly on the investor's behavior, which can be a learning lesson or a learning tip for other viewers. So Shweta, welcome to the show, and let's begin. Let's take Ramesh's question first. He says that he's got SIP in Nippon India Sensex Index Fund, UTI Nifty Next 50, Parag Parikh Flexi Cap, HDFC Flexi Cap, Motilal Oswal Mid Cap, Nippon India Growth, SBI Small Cap, Tata Small Cap, Motilal Oswal Micro Cap 250, SBI International Access Equity also. Currently, the portfolio value that he says is around 30 lakhs. He wants to make 100 crores after 18 years. And in addition to this, he says that he has invested 10 lakhs in corporate bonds and 12 lakhs in direct equity. Very interesting, and I think well diversified as far as fixed income is concerned and equity is concerned, although equity can be slightly more consolidated. So yeah, Shweta, how can we go around it now?
Hi, Kavita. Thanks for having me on the show. Mr. Ramesh has a good diversified portfolio, a little bit too, as you're right, because FlexiCap also he has multiple. For example, there are some things that I would like to change, but overall he's done quite well. The 10 crores in 18 years would need him to do about 2 lakhs, 2.2 lakhs a month to get to his goal. It looks quite balanced, but some of the schemes maybe quite volatile. For example, he has Motilal Oswal Micro Cap, which could be very volatile. He has SBI International Equity, which also could give lower than expected results over time. But could also be quite volatile depending on how the markets do there. The only advantage he gets there is with the currency fall that we are seeing, his portfolio will do well. We are seeing Nippon India Sensex Index and UTI Nifty Next 50 Index Fund. I think he could sort of change one of the schemes, but I don't want to add too many schemes also at the moment. SBI Small Cap is another scheme that I think he can change, but I really don't want to add too many schemes. But if he stops SIP in these two schemes, he can add something like an Invesco Mid Cap, which would give him more diversification, I believe, and more stability in the portfolio. I don't want to add more small caps, so that's why I think a little bit of that change might be needed.
Okay, so that's the solution for Ramesh. But then having said that, I also want to understand how many FlexiCap can one really have. He's got really the best performers, Parag Parikh FlexiCap and HDFC FlexiCap. He also has a large cap passive approach and passive investments. He doesn't need all of this.
Exactly. So, in both of these, like the Nippon India Sensex and UTI Nifty Next 50, he can choose one of the schemes. He doesn't really need both. FlexiCap also, while FlexiCap as a category has done well, and these two are the toppers in this category, he doesn't really need both FlexiCaps. There will be, if you see an overlap between the three schemes that I mentioned, Nippon, PPFS and HDFC, there will be a huge overlap. So while he may believe that there is diversification, there will not be an adequate diversification. That is one of the reasons that I thought, he should add a mid cap there, because if you see as a category, he only has Motilal Oswal mid cap, and you do have a larger universe of mid cap that you can see, and different strategies. So if he sees a Motilal Oswal mid cap, which is a more concentrated portfolio, he could add like an Invesco mid cap, which is a more diversified portfolio, and you will see little overlap usually with Motilal and other schemes. Even if there is an overlap of some stocks, the weightage will be different. So I think that will give him the diversification that he really needs.
Okay. Let's move on and let's take Sahil's question. Um, Sahil says quant small cap, Bank of India LSX tax saver, Motilal Oswal mid cap, Bandhan small cap, investing in these funds and SIP from 15 months now, and he's going to step it up by 10% each year. 3,000 in quant small cap, Bank of India LSS and Motilal Oswal mid cap and small cap of Bandhan. He's investing 1,000 rupees via SIP. Okay, I really don't have the corpus idea that he wants to accumulate, but having said that, I just hope Sahil knows that Sahil is aware that he is in the old tax regime, which is why he's taking advantage of investing in ELSS. But even if he wants to take that benefit, he can take a better ELSS fund. Is that right?
Yes, so I think two things I would want to change for him. I would want to change his ELSS scheme for sure, and the quant small cap as well. Because if you see, he has more mid cap and small cap exposure here, and quant he has on three times the exposure that he has to any other scheme. So I would actually want to change that. And if he does have ELSS sort of aspirations, I would say put in more in ELSS. So, for example, if he puts 5,000 in ELSS, there will be a lock in of 3 years for sure. But it is effectively what we are telling them, right? That you invest in for the long term, and he will take advantage of both things. He will have large cap diversification, and he will take advantage of the tax benefit that it gives him. So he can do like a DSP, ELSS is what I would recommend. He can look at HDFC. He could look at one of these two or both, because Bank of India is something that we'll ask him to stop as well.
Okay, and also we would like to have more details just in case he needs further direction or recommendation of the portfolio, because so far just having a fund specific approach and stepping it up, although the right thing to do and the right first steps to take, but then he needs to align it better, and if there is a goal aligned to it, maybe he doesn't want to invest for like 5 years, maybe the investment horizon is only 3 years, Shweta, the strategy changes, the funds also change, is that right?
Absolutely. So, since he's not mentioned that, we are assuming, both you and I, that it's 3 years plus at least bare minimum, but over a long term. But if his strategy is only for 3 years, for example, then yes, we will direct him more towards hybrid schemes or even debt for that matter, because over the next year and a half, his tenure will then be reduced to half. So I think that is something that he should definitely look at.
All right, so that was Sahil's question. Um, okay, so before I move on to Raghav's question, I really want you to help our viewers understand the benefit of having just plain vanilla funds. Okay, this might sound really very tricky right now, considering there are so many options. We have sector thematic funds, we have weird, we have not weird. Sorry, that's the wrong word. We have a large category in passives, and even within equity, we have different sort of combinations as far as exposure is concerned. But is it still right to have a pure large cap, a pure mid cap, and a pure small cap just to begin your investing? Does that mean that you are very traditional in terms of equity investments via mutual funds also, or you think that is actually the way to go?
I think that's a great way to go. I think it's I wouldn't say no brainer, but I think it is a straightforward way to go. And anybody who wants to focus on the long term, who wants to focus on building wealth and not be distracted by the noise saying, take these tactical calls, take these momentum options. I think a good pure large cap, good pure mid cap, good pure small cap over time, when they add starting off with large and mid cap, I think as categories would serve investors much better than say, let's do these thematic funds, because you do have to get the entry and exit it right in sectoral and thematic funds. So while they may be good for dinner table conversations and cocktail conversations in parties, I think the best way to build wealth is to have some of these plain vanilla products. I know investors like to add that oomph to their portfolio. So maybe a small allocation, maybe 3 to 5% is okay for that excitement. But I would think pure plain vanilla, as you put it, is a great way to build wealth.
Exactly. So keep it simple. That is actually being trendy, and maybe you can try experimenting and add some tadka to your portfolio on in the second stage of your investing, because since you're just beginning your investment, you also need to learn about a lot of funds. You also need to do your homework as far as knowing how the market works, and accordingly you can strategize your portfolio extension. But having said that, let's take Raghav's question. Shweta, and Raghav says that he's doing monthly SIP of 20,000, and he's also ready to step it up by 10%. HDFC Multicap, ICICI FlexiCap, SBI Balance Advantage, Motilal Oswal Small Cap, and Geo Mid Cap. And okay, so he's very well thought about his investments. 1 CR in 10 years, that is what his target is.
Okay, so Raghav, I think great start. But you would need to increase it to 30,000 per month with a 10% step up to get to your goal. I would say instead of SBI Balanced Advantage, do a UTI or a DSP Nifty 50. So give that core to your portfolio. And instead of like a Geo mid cap, do an Invesco mid cap. I would go with the proven strategies, which are more diversified and with good fund managers. So I think that's my recommendation.
All right. As far as fund mix is concerned, I think that is great. Acha, let me just also talk about the Geo and the kind of funds they are coming up with. A new entry in the market, but then investors seem to be latching on to it.
Yeah, because it's interesting, right? The new mutual fund is coming. People think that they're going to get things for cheaper, which is not really the case, right? Because they are going to buy at the same price that is available for other mutual funds. But just the fact that you're going to get it at 10 NAV, I think, is what excites investors. So, which is why they go for NFOs. But even as a mutual fund, Geo is a good brand that is coming up with the mutual fund. So I think investors do want to make sure that they are committed to a brand like Geo. It's not a small brand that's coming. BlackRock has got experience in the Indian markets as well. So I think it'll be quite an exciting space. But like I said, for newer investors, I would stick to proven fund managers and proven track record rather than jumping with newer fund houses or AMCs, because we do have to see how it goes. While I do think the excitement is there, but for newer investors, especially, I would say stick to older funds. Maybe add these a little later stage in your portfolio.
Let's talk a bit on the NAV and the cheaper NAV aspect of buying an NFO or a new AMC maybe. Isn't that an advantage? Isn't it good? Why is it bad to buy a fund with a lower NAV? That'll be cheaper, right, for an investor?
No, so in mutual funds, unlike stocks, the NAV doesn't really matter. In stocks, the prices matter. In mutual funds, the NAV is just a factor of the prices of the stocks, right? Especially when it's in equity. So, for example, you're buying, say, a Geo scheme because we're talking about it at 10 rupees NAV. Similar scheme, I'm buying at, say, 20 rupees NAV. And we both have the same portfolios. So, if just for argument's sake, here, say your portfolio is doing well by 20%, mine also does well by 20%. So your NAV will become 12, mine will become from 24. So the gain percentage is going to be the same irrespective of the NAV, right? So NAV actually doesn't matter in mutual funds. It's just a feel good factor. Okay, we got in at 10 NAV or base NAV, but really the idea is that you get it, you get a good portfolio so that the gain is more, so in percentage terms is what it matters. I don't The NAV doesn't really matter.
Let's take other question. Let's talk about Thomas's query. Okay, so I believe you've got his portfolio with you, and he wants your expert opinion. He is 60 years old and he can take moderate risk to earn more from equity funds. Future requirement or near future requirement is 50 lakhs for his daughter's marriage within 2 years. Rest money he can hold for a period of 5 years, and he needs to know whether to make he needs to make any changes in the portfolio. The investment he's made is through SIP and lump sum investment during the period shown in the attached schedule. Okay, so we have the details of that, and he doesn't have any SIP or any plan of lump sum investment now. So he wants to know that he used to redeem funds whenever he needed money for his routine expenditure. So very interesting and very well thought, because he knows when he needs the money, that is within 2 years time, and after that he can keep that money invested for 5 years. But I'm still not sure that he will be dipping into his investments even after this for his routine expenditure. Has he got his pension sorted? I don't have those details with me. Do you have the funds on you, Shweta?
So is this the Excel file that you're talking
Yeah,
about?
yeah, Thomas.
Yeah, I have that with me.
Sure.
So the funds are looking good, except for the exposure. I would say, I would change some of bit of the exposure to some of the funds.
Hmm.
For example, the SBI Contra Fund has about 20% of the portfolio from what I can see. So I would cut down that to a reasonable amount. I would also cut down UTI Balanced Advantage Fund if I had the clarity of whether he needed the cash flow. If he needs the cash flow, I would not cut down the UTI Balanced Advantage. But I would definitely cut down on the SBI Contra Fund. It has done well in the past for him, but I think over time he needs to understand that this money that he may need over the next couple of years, especially, that is something that he should sort of set aside. He does have Kotak debt hybrid fund, which I think he should be able to use for his daughter's requirement. ICICI Pru Multi Asset Fund is another fund which I think will do well for him over time. So I would not recommend what funds he should withdraw, except for say, maybe an SBI Contra, which I would say he should cut down right now rather than later, because the exposure is too much. And that is pretty much the only reason I'm asking him to cut down. In terms of large cap equity, he has Canada Robeco Blue Chip done well in the past. It is about 10%, 11% of his portfolio. I would not add too much more because it's already there. He doesn't have any really passive funds, but he does have a sectoral fund, which is about 5% of his portfolio. He has a quant ESG fund. I think that is something that I would time my exit. So when he must have a reason in mind when he entered this scheme. So I would say, exit when you think the time is right. He has been invested in it for a couple of years now. So I
Hmm.
would think he could cut down that exposure when he wants the funds next.
Okay, so very important, and more details would have really helped us in formalizing a strategy for him better. But having said that, how common is it for retired individuals to dip into their investments for routine expenses? Shweta?
It is common because most of them don't really have a pension fund or pension coming in. So they would really need to dip into their mutual funds or their regular portfolios that they built over time. The only thing that they should do is match their cash flows. So plan their cash flows for at least the next 3 years and make sure that is available to them, because if that is left to the mercy of the market, then that's something that could go quite haywire. The other thing they usually forget to sort of account is the amount of inflation it would add. It would double over the next 10 years, depending on their lifestyle and inflation. People don't realize when they get more time, their expenses also increase because they have to do something with their time, something productive, especially. So whether it's their hobbies, whether it's some sports, whether it's some personal training that they get into, the expenses do increase. So I would definitely ask retirees or people looking into retirement to take some of these things into consideration, account for some more expenses, and before you dip into your portfolios, make sure the portfolio is allowing you to live your life fully and making sure that throughout it is there. Because if you're not going to do that, after 10 years of retirement, if the portfolio is going to get over, then you're in trouble. You could replenish it now rather than 10 years later. So I think this planning is not being done as well as it should be.
Exactly, especially at the stage that an individual is, post retirement, if you don't have any income source, you really have to strategize your investments really well. And there comes the parameters or the criterias where you cannot, invest more in equity if there is a goal still aligned, or if there is any financial liability still there on you. Shweta, that becomes a very tricky stage. You are retired now, but you still have financial liabilities, responsibilities. Like in Thomas's case, he has to get his daughter married in next 2 years time. There might be other funds also available. We are not sure about that because we don't have those details. But having said that, there is a responsibility that because of which he has to dip into his investments. Okay, so that makes you sort of very guarded with your investments also.
Absolutely. So if he had told us how much he would need, for
Yeah.
example, on a regular basis, we could have advised him on what he could do or even cut down some of these goals. See, because while 50 lakhs may be aspirational, if this is going to affect his regular life post-retirement, he could probably cut it down. So for example, we could have said, instead of 50, do 40. I'm not sure what his goals are otherwise and what his funds are otherwise. But we could give that kind of advice as well, which would make sure that his retirement is also comfortable and not just that one goal which they're going to provide for.
All right, I think with that, it's a wrap on the show as well. Thank you so much, Shweta, for being on the show and helping our viewers with their financial portfolio queries. And for our viewers, I'm going to leave you with our WhatsApp number, email ID, so that you can send across all your questions, investment, insurance, tax on your investments, credit card, or anything about your financial responsibility or loan that you want our experts to guide you and help you out with. Do send across your questions on the WhatsApp number and email ID. Thank you so much for watching. Goodbye.
What if assistive technology could become the bridge